to Weekly Profit Talk. We do this every single week on three channels, actually. We're on Facebook, LinkedIn, and YouTube. So this occurs at 8:30 a.m. every single Wednesday. This being Wednesday and at 8:30 a.m. Mountain Time, here we are. And today's topic is the difference between profit and cash flow. This is one of those things that confounds lay people, and I hope to make that a little bit more clear for you in the next few minutes. So let's talk about that for a little bit. I actually got this question. I'm going to go ahead and let's turn this on. And by the way, the chat's on. So if you have any questions about anything that you're seeing, go ahead, type them in. I'm going to hold them until I get done talking here for about 3 or 4 minutes. So actually, when I was early in practice several years ago, it's been about 7 or 8 years now, actually, I had a client ask me, why does my profit and loss statement look completely different from my checkbook? And I just was so stunned by the question, I didn't even know how to answer it. And I found myself kind of hesitating and stuttering a little bit. But the plain fact of the matter is this. The business operating checking account of your business does not represent the entire business activity as it relates to everything that you're doing. The money coming in certainly should go into your business operating checking, and many of your expenses go out there, but you also have other accounts as well as credit card accounts. Hopefully you're using those in a wise manner, i.e. Allowing for automatic recurring payments of things that you need, but also make sure that you're auto paying your statement balances. A credit card is a valuable tool when used wisely. And by wisely, I mean it should not be used as a debt instrument. Let me say that again. It should not be used as a debt instrument. Okay. Credit cards are basically a purchasing tool and a way to legally delay payment on things from between 3 to 6 weeks. What they should not ever be is a way to borrow money. So let's briefly go over, I got a little bit on a sidetrack there, but the difference between profit and cash flow is simply this. Profit is the money that you have left over after you pay the expenses that are created in the process of making that money. Simply, you're going to have costs of labor, manufacture, if you make something, and also all the selling and administrative expenses, everything that you can think of that would go on a tax return, advertising, bank charges, insurance, meals, the list goes on and on. Our cash flow basically is all the money that comes into and out of your business, whether or not it ever touches your profit and loss statement. So cash flow is significantly different from profit. Let me go to here. As I said, if you subtract the cost of labor and manufacture, if applicable, means simply that if you create widgets somehow, it took a lot of financial accounting in college, and they like to go into the whole cost accounting thing where you're purchasing raw materials and turning them into widgets and then selling them to customers. Most of my medical practitioners, this isn't a thing. You're basically, if you are providing supplies or other goods to your clients, it's usually on a resale capacity as a course of treatment, but and nevertheless, it's always possible. And then all the other things that you have in your business to run your business. And I'm thinking of some other things. Rent's a good example. Utilities. You may have uniforms. If you, in fact, actually wear a white coat when you see patients, that is a write-off because definition of a uniform is something that you can't wear out to dinner or in your otherwise normal life. It's specific to your job. So with that, let's take a look at cash flow. Now, cash flow starts with the operating revenue. When you use the direct method of measuring cash flow, there is a financial statement called the statement of cash flows, very aptly named. And this will take your net income from your profit and loss statement and then basically adjust that amount of money by the other things that come into and out of your business. If you make a purchase for uh, an asset, something that you're going to keep for over a year, which is known as a fixed asset, money flows out for that. That is not necessarily an expense because you have money coming out of a bank account and into the asset. So that's not touching your profit and loss statement, but it definitely touches your cash. So uh, conversely, if you sell something for salvage or because you're upgrading to something newer and better, then that, of course, is an influx of cash. You have a capital account in your business. Think of it as the same way as your primary home. You have equity in your home if you have taken a mortgage out, you've been paying on it for some time. That 20% down that is typical. That plus the principal portion of the money that has gone into your home relative to its current fair market value, minus what you still owe on it, creates a difference. And that difference is called equity. That's the money that you have in your business as well. So your equity is simply the cash that you've contributed minus the money that you've taken out. And that is adjusted for your net income every year as well. But if you put cash into the business or take cash out to live on, which is more common, then of course that touches cash as well. And of course, those loans that you may have for those assets, you are able to expense the interest portion of that. Loan payments are always a split transaction. You have interest, which is a write-off, and it reduces your gross revenue and also your taxable income. But the principal portion is basically paying down an asset. Well, actually, technically a liability. It's increasing the value of your asset as the liability goes down. So that's cash out. And then you have depreciation entries as well. I recommend if you have large assets that you actually calculate your depreciation for the upcoming year and show it as an expense on your monthly financials. So hopefully that clears things up. The difference between profit and cash flow: profit is the money you make after all the things you have to spend to make the money. Cash flow is all the other cash that flows in and out of your business and goes beyond the what I mean to say is it basically starts with profit, but it is also adjusted for many other things. So um, as I said, I hope this is helpful. If you have any questions at all about anything or about how you might be able to work with us, then please reach out. As you can see, we're on all three. There are three different social media channels. Sorry, Instagram, I can't figure you out, and I don't think the people that we're reaching out to necessarily go there very often. But YouTube, LinkedIn, Facebook. If you're on any of those channels, pop a comment. We are creating content every single day, and we will see whatever that you put into comments. You can direct message or email eric@owingsllc.com. And if there's anything we can do to help you at all, let us know. Until next week, every single week at 8:30 Mountain Time. That is 7:30 in Los Angeles, 10:30 on the East Coast. We will be back next week. It's going to be a brand new month, and we're getting close to the end of tax season. Thank goodness. So with that, we hope you have an amazing day and a great rest of your week. And if you have a chance, do something randomly kind